Welcome, ladies and gentlemen, and we are going to cover little-known strategies to pay less tax and not outlive your savings. I am Jim Cunningham. I've got Hobie Beman here from Midland National Life Insurance Company and Lindsey Orta from Ascent Wealth Management. So let's get right to it. This is a disclaimer. I'm a lawyer. Lindsey is a financial advisor, and Hobie works at an insurance company. This is not legal advice. This is not financial advice. This is 100% information, and we'll give you instructions on how to get your questions answered in a more in-depth setting. We do have a Q&A, so go ahead, and if you have a question, put it in the Q&A, and we will get to those questions. If you're watching this on YouTube, we're not live if it's on YouTube. It's recorded, so you won't be able to, we won't answer your questions, but you can put those in the question feature there at the bottom of YouTube. Also, subscribe to our YouTube page. That's really important so you can stay abreast of all these great things that we're doing here. Christina, as I mentioned, she's with Ascent Wealth Management. I'm Jim Cunningham, and we've got Hobie Beman here. So I'll let you guys take it away.
Wonderful. Thank you, Jim. So yeah, we've wanted to just kind of present some of what is this impending, tax problem, if you will. And what we do know is not just because we're entering a new administration where we've got, undivided government, and based on the Biden administration, it is a fairly aggressive tax policy, fiscal policy, where we should expect to see eventually some tax hikes. And, the expectation is increased in individual income tax rates, and increased capital gains tax rates, increased corporate tax rates. And so those are all things that are intended to be implemented. Coming out of a recession, they'll probably be hard pressed to implement that, coming with narrow margins in the House and in the Senate. And it just isn't good for the economy coming out of a recession. So this isn't something that we're probably going to see until at least 2022 begin to be circulated, as far as what that legislation will actually look like based on what their agenda is and what will be proposed. So it is something to prepare for. All that aside, even if there's nothing passed, the tax law is currently set to sunset in 2025 and revert back to what it was in 2016. So at a minimum, we know taxes are going to go up if we do nothing. But if we are realistic, we'll probably see with this administration some introduction to their tax policy going up. Is inevitable, especially with all the stimulus spending. At some point, taxes will go up. So I think that as long as you're in that camp of taxes will go up sooner or later, then this is what we're here to talk about, is how to deal with that inevitable future tax liability.
Yeah, Christina, you raise a really good point. Not only are the rates going to go up in the future, but many of our clients have very large retirement accounts. Right. Correct. So it's not uncommon for a person to have $1 million or $2 or $3 million retirement account. And once you hit 72, you got to start taking money out of that account. And that kind of pushes you up into a higher tax bracket. So that's what we're going to be covering. And frankly, I think one of the biggest mistakes that clients make is they don't put enough thought and effort and planning into this big increase in their taxable income starting at age 72. And so for those of you who've already hit age, well, it used to be 70 and a half. For those of you who'd hit age 72, you know what I'm talking about. And for those of you who are getting close to that, this is a real issue, because if you have put all this money in your 401k or your IRA, maybe you rolled it over into an IRA, that money, those cows are coming home, and you're going to have to start taking out over 3% a year, whether you want the money or not.
And to add to that, Jim, I would say, it's important to think about not just once you've gotten to 72 and that money being forced out and the taxes that, will be inevitably paid on that money is, in a rising tax environment, people think, hey, when I speak with my CPA, my CPA is using the word save on taxes by funding into my 401k or my IRA or those things. But really that word save is misleading, because you're simply postponing or deferring the tax. And the idea is that when you retire, you're going to be in a lower tax bracket. right? So you put it in at a high bracket and you take it out at a lower bracket when your income is lower. But in a rising tax environment, like with what, to Christina's point, that sunset provision, we know with no action by Congress that taxes are slated, it's signed into law with nobody doing anything for taxes to go up marginally in 2025. So even if your income comes down, that doesn't necessarily mean you'll be paying less in taxes when the money comes out of the account. So it's being prudent now and preparing your overall retirement plan to have some balance in it so that you can manage your taxable income during retirement or during distribution.
That's correct. So Jim, do you have the slide there that speaks to the future RMDs? Just kind of the problem there. Yeah, so let's talk about that first. And so really what we want to highlight here is those future required minimum distributions. And so we'll go back to that other slide in just a moment. But what I want to highlight here first is, what is the future required minimum distribution? And so if we have now those required minimum distributions are based on the Uniform Lifetime Table. And so that is published by the IRS. And every December 31st, that will your year-end account balance of your all of your IRAs, 401ks, 457s, 403bs combined will determine the withdrawal that you're required to take starting at 72 for that year. And so what we're giving here is an example of $1 million IRA 401k balance. If you do not make any future contributions, that will be worth nearly $2.7 million at 72 if you take no withdrawals and no contributions. That required distribution is $125,000 of additional ordinary income added to your taxable income. Now, and this is just assuming a 6% rate of return. So we've been in an environment over the last decade where many of you have probably experienced, as long as you're not sitting in cash on the sidelines and bond funds, then you're probably realizing higher rates of return, closer to 8 to 10% per year at a minimum over the last decade. So 6% is a fairly conservative number to average a 10-year average, even from 2008 to 2018, when 08 was down, and you went through the Great Recession, and even through 18 when the market was down 6%. If you did that 10-year average in a balanced account, you still averaged just shy of 7% a year if you didn't pull the money out and jump ship during the bottom of 08. And so that realistic rate of return. Again, these numbers are only going to go up if you have a greater rate of return. Now, if you have a $2 million IRA or 401k, which is not unrealistic for many people that have contributed and won the tax deferral game and deferred. So sorry, go back, Jim. Yeah, $2 million. If you do max out your contribution over age 50, that currently is $26,000 a year. And if you max out your IRA or 401k deferrals and add money until 65, then retire, make no more contributions between 65 and 72, your account balance at 72 is 5.3 million. And essentially, what you're looking at is a $230,000 RMD. And so $230,000 a year is going to get added to your taxable income. So here is the problem that eventually we're all going to have to deal with. And what we want to highlight is some solutions that we could look at now and today. And this is really a sweet spot for people that are 55 to, I'd say 67, 68 is kind of that, that especially if you're 65, you can see that 72 required minimum distribution coming down the barrel. And you're going to have very large 6-figure required distributions. And so if we can look at some strategies to pay less taxes now, or a little tax now and 0 to very low taxes later. That's what we're going to talk about today. So Hobie, I'm going to turn it over to you to talk about the tax tables, which is really the next slide, I believe.
Thank you. One more.
One more.
There we go. All right, so just to give a little context, because I know there's a lot of numbers on this slide, on the left-hand side of the screen, you'll see 2017 tax tables. So when you look at that, what I want you to think about is prior to the Tax and Jobs Act. So that was what the taxes looked like before the current administration came in and we had the change to the tax law. So on the right-hand side of that, it says 2019 tax tables. They're slightly adjusted for 2020, 2021. But that is the current, those are the current brackets that we will see until 2025, assuming that there is no change legislatively with a new administration coming in, which, you know, Christina had mentioned. So if nothing changes, we're going to be sitting with these 2019 brackets until 2025, and then we'll be reverting back to what we had previously, which is that 2017 tax tables on the left. Now, I want to point out a couple things with these two tables, using a little bit of math, and to really help people see the gravity of the differences in the changes. So assuming that a husband and wife married, this is a married filing jointly, is making $150,000 or really up to $168,400 currently, you can see that they would be in a 22% tax bracket marginally. So when we look prior to 2018 or in 2017, they would have been in a 25% tax bracket, right? So a lot of folks go, well, so the taxes are lower now, but not substantially, right? They're 3%. But if we do the math, how many times, what is 3% into that 22? And what we know is that's over a 10% reduction in federal income tax on that money. So yeah, it is only 3%, but as a percentage of how much taxes that you would be paying, it's over a 10% reduction. So what does that mean? It means that when we, assuming nothing changes with Congress, what it means is that when we get to 2025, those taxes will be going up at least what we're seeing, the difference between these two tables of over 10%. And then what you find when you go down a little further into that 24% is that on the right-hand column, the 24%, it basically encompasses the 25 and all of the 28 on the left side. So if we just kind of look at the difference on the left-hand table between 25 and 28, and we just said effectively maybe 26%, well, the difference between those two can be staggering on how much that you'd be paying in taxes in real dollars and cents. So the difference between the column on the left and the right, depending on which bracket you fall into, can be anywhere between a 10% increase and maybe a 25% increase in federal income tax. So if nothing changes, we know that most people's taxes will be going up between 10 and 25% after 2025. Now, that to me is a large amount, and it's a big reason, or a big part of the reason why we're talking today about what options you would have to, I guess, insulate yourself from those future tax increases and to maybe create some balance in your overall plan so that you're not a victim of these future tax codes. Now, to take it one step further, what we've done on the very right-hand side of the screen is we've shown you what the brackets, what the tax brackets looked like in 1986 and 1980. And then we adjusted for inflation, or the consumer price index, into today's dollars. So it's 1986 brackets, but it's in today's dollars. Because a lot of people, when we have these conversations, they say, I understand that what you're telling me to be true about taxes going up in the future, but if I'm making less money in retirement than I am now, because I'm highly compensated for what it is that I do, then I will still be paying less in taxes when I retire. So what I try to help people understand is that may not be true, because if you are making say a husband and wife are both making $90,000 each a year, $100,000 each a year, and you have $180,000 to $200,000 in income, even if we cut that in half in retirement and we say we have $100,000 in income, right, as retired, so we're making half. So instead of paying, say 24% now in federal income tax, when we go forward, if we were to come back to these types of brackets that we're seeing in the 80s, which is quite possible, $100,000 in income would put you in a 38 to 42% bracket in our example, based on adjustments with inflation. So even though the client would be making, or the individual would be making half as much as an income, they could literally almost be doubling the amount of federal income tax they're paying on that money. So postponing paying the taxes until you're retired, especially in a rising tax environment, is not a great solution, and can put you in a situation where you're paying a lot more really than you need to be or should. Jim or Christina, you have
you know what, when we take, I will tell you, when we take a long-term view of the world we live in, and as we're recording this, it's January of 2021. I think back a year ago, and first of all, it feels like 100 years ago or 10. We're living in a completely different world. If I could go back and tell myself a year ago that all this stuff would have happened in the last year, I just wouldn't believe it. I mean, everything I'm talking about, and I'm talking about COVID, I'm talking about all the unrest, all the weird stuff that's happening. But something you guys really need to pay attention to, and I don't want to get down in the weeds, but I have to mention this, is that the Fed raised its target inflation rate from 2 to 3%. We also have this sort of blue wave, small ripple, whatever you want to call it, and I'm saying this in a non-political sense, but absolutely the something you need to pay attention to is something called modern monetary theory. It's also called magic money tree. Modern monetary theory says this: the federal government can print an unlimited amount of money. There's no limit on the amount of money the government can print, and they can put that into the hands of Americans, basically, with the goal of lifting the 17% of the population of the United States that lives in poverty. Now, you may think, well, if the government prints all this money, inflation's going to get out of control. Well, modern monetary theory says that taxation becomes a fiscal tool, not just a way to or a monetary policy tool, not just a way to get money through a fiscal, like collect tax revenue, but as a way of adjusting the monetary system in the United States so that with the big spending, and we've seen the big spending in the last year, there has to be big taxation because otherwise you're going to have spiraling inflation. If the amount of money exceeds the capacity for the economy to absorb it, prices go up. And so what I firmly believe, I don't think we're going to see it this year. We will see it next year. Taxes are going to go up across the board. We put up a video on our YouTube page on the Biden plan, the Biden tax plan. It's an effective estate tax rate of over 80% for Californians. I think that's coming. So you really need to pay attention to this. And this may be like the year to do this planning in 2021. So don't wait. What we've seen with Prop 19, there's this wave of people coming in. Lawyers can't handle all the cases that are coming in. And I think the same may happen on the financial services side as we kind of come up on the end of the year, is you're going to see this rush to financial advisors because people are worried about taxes in the near future. So modern monetary theory, please pay attention to it. I think it's inevitable that we're going to see a tax increase. By the way, a tax increase only requires 50 votes in the Senate, and you've got the vice president who can cast the deciding vote. It's much harder to cut taxes than it is to raise taxes, much easier to raise taxes. So I'll let you, on that happy note, I'll let you guys take it from there.
And just to add what you're saying is, listen, regardless of the 50 votes and the vice president, right, this is already signed into law. We're looking at a 10 to 25% across the board increase in federal income tax for all parties at almost every income level. So the thought of to be prudent now, to start doing some planning to add balance from a taxation standpoint to your plan, I think is, it's never been more relevant as it is today. And we've got a finite period of time. I mean, between now and 2025, you've got a 4 or 5 year window which could be shorter, right, depending on what happens in Congress. But if nothing happens, that window is 4 to 5 years before we see that increase.
So what
Yeah.
do we do? What can the people who are watching this? We got a lot of people on this webinar. What are some of the strategies they can use?
Yeah, so let's talk about some of the strategies. And, realistically, I know one of the things that Hobie had mentioned is, what if you've got a husband and wife joint household income of $200,000 today, expecting to have less income in retirement? And that's kind of the, I'd say that the fairy tale story that we've all heard for so long is that you're going to spend less in retirement. And I can tell you from doing this from a long time, people don't like to live on less than they've been living on. The only thing that you're probably not going to have is maybe that $26,000 deferral that you've previously been deferring. But the net income check that you've been living on, most often, I'd say over 90% of the time, my retirees do not like to spend less in retirement. So let's talk about that, what we can do as far as some strategies go. And so, Hobie, I'm going to turn this over to you. Let's maybe look at funding the life plan, and we can look at talking about how that compares to why the life plan would be better than a Roth IRA. So we probably want to go back a couple slides. Would that be best?
Sure.
And so let's go back 2 more, Jim, I think. There we
Great.
go. So we're going to propose this in 2 different ways. We're going to show this to you in a for those of you visual versus more of a illustrative version. We're going to show this to you in a couple different ways, but this is kind of the scenario, and I'll let you go through that, Hobie.
So Christina, so I guess, really there are two ways, kind of mainstream ways that you can look at adding, I guess, balance to your overall financial plan, right, from a tax standpoint. And really it's creating a pool of money using different financial instruments that are out there to create tax-free income or tax-free access to funds in retirement so that you can manage taxation and manage the distributions in retirement so that you can, again, just pay less or pay a lower effective rate of taxes in retirement. So with that said, this strategy basically is using an insurance policy. And basically what we're doing is we're funding it over a 10-year period of time. And we're putting the contributions into the policy, and then we're taking distributions from it in the future in a tax advantage way. So in this example, we're looking at putting $50,000 away each year, and we're doing that for a 10-year period of time. So that's the total of contributions of about $500,000 towards that individual's financial future. Based on historical returns, using an index strategy, which mitigates downside risk, that money would grow over that period of time from $500,000 to $773,908 in this example. And then once we reach retirement, the benefit, in addition to having the cash value, the client, if something were to happen to them or they were to pass away, all of this money would pass to their spouse or their loved ones tax-free. And that number is just over $1 million coming back to their estate. Now, that is your working years, so to speak. And then you've got the retirement distributions, or what I call the margarita years. And basically at age 70, we're seeing annual distributions from the plan of $73,104. Now, to talk a little further about that $73,104, that money is coming from the policy via policy loan, and in the current tax environment would come to the client tax-free and not reportable on their tax return. So this would not increase their AGI, and it would not lift their effective tax bracket when they're taking distributions in retirement. So it helps create that balance, or that amount of income that they need to live without pushing them into these higher brackets. That's that balance that I was speaking on earlier. So they receive that $73,000 a year, and they would take those distributions for 20 years, right, which would put them at age 90. So by age 90, they would have taken $1.4 million in tax-free income from the plan. And at age 90, there still would be almost $250,000 in value left in the plan. And again, at 90, if they were, if they passed away or they needed some form of in-home care, assisted living, or care in a nursing facility, they'd be able to access that death benefit of $354,000. So that money would be accessible in addition to the 1.4 they had already received. So so look at that from I guess a pictorial or a graph view. If you want to move to the next slide.
There's a couple. I think we're a little out of order, but that's all right.
It's okay.
Keep going.
Next.
We're just taking a walk through the slides.
Next.
Next.
Keep going. There we go. So graphically, basically, we're putting away 500,000. It grows to 773. If something were to happen to you, your family would receive that $1 million tax-free at any period of time during the contributions. We make it through the contributory period. We're lucky enough to get to retirement. We then receive $1.4 million tax-free from the policy via policy loans over that 20-year period of time. We're now 90 years old. There's still about $250,000 or just shy thereof in the policy. So if you're happy and healthy, you can continue to take distributions. But if you need some type of care, whether that be in your home or in a nursing facility, you'd have access to the $354,000 while you're living from the death benefit to help offset, those types of care costs. And if you didn't need care and you simply pass away, your family would receive an additional $354,000 in tax-free death benefit paid out, or a little just shy of, $1.8 million in distributions throughout the course of retirement.
Now, one of the things that I want to have you kind of speak to, Hobie, is you mentioned policy loans. So obviously this is a life insurance product. This is one of many solutions we can look at, but this is one that we happen to be talking about today. Mm-hmm. And so this would be based on someone being insurable. And the nice thing is, if it is, let's just say, husband has the large 401k, we could do the life insurance on the wife. She's the one insurable. So it doesn't mean that because your 401k is the $2 million 401k, you have to be the one to be the insured. We can look at options for you. But I do want to have you speak to loans and what that really means. How does that work?
Right. So basically, it's I don't want to say it's a play on words, but basically they're collateralizing the money that you have in the policy, and the insurance company is sending money from their general account, right? So because it's coming from the insurance company and they're simply collateralizing the money that's inside of your policy, that money is coming to you tax-free. If we were to take a distribution from the contract and it were more than the basis, then that would be taxable. But because it's coming to you via a policy loan, which for the client wouldn't be able to tell or look or feel any difference between a policy loan and a distribution. It's just the way in which the money is coming from the insurance company. That's what allows it for it to come to the client tax-free.
Let me put some color on this. For those of you who are watching this, something you need to know is life insurance predates the Internal Revenue Service, the Internal Revenue Code. Life insurance predates World War I. It predates the American Civil War. It's been around a long time. I think probably the single largest lobby in Congress is the insurance industry, if I'm not mistaken. Something to understand, when you put money into a life insurance policy, it comes back out income tax free. And so what we're doing is we're able to put money into a life insurance policy that grows tax free, and you borrow it out tax free. And when you die, there's no income tax. Now it is subject to death tax, to estate tax, but life insurance enjoys this real favored status in the Internal Revenue Code. And so this is why this works is we're removing this taxation. And that's why we sort of laid the foundation with the increases in taxation. Do you guys mind if we do a few questions? They're kind of piling up here. Sure. Jay asked, aren't changes to the table supposed to occur with the next year or two because of increased life expectancy? That's the uniform table. Have you guys heard anything on that? I haven't.
I haven't heard about the life expectancy table changing, and when they do, they're typically marginal.
And Jay, something to understand is that is something the government hands us these are the life expectancy tables to use. It doesn't necessarily correlate with reality, and it doesn't change as life expectancies change. And then Anita asks, I'm a little confused. So if this was discussed, forgive me. So it's not prudent to take RMDs, pay the tax, and put it back into a portfolio as a reinvestment. What we're talking about here, well, certainly you have to take your RMD out because it's required. R in RMD means required minimum distribution. But then what we're talking about is actually doing this before you hit your RMD, right? Aren't we talking about doing this before you hit age 72?
so
Or can you do it? Can you do it after 72?
Before we get into a couple more questions, Jim, I think it's important to highlight slide number 5. Let's go there, and then let's go to slide number 7. And so slide number 5, that is.
I see, now I see the numbers.
Sorry, forward one more.
Okay.
So what we want to talk about is taking money out before 72 and paying that lower tax rate that we first talked about in the tax tables, paying a little bit of tax now, letting it then grow tax free as opposed to tax deferred, and then taking out money later. And so what we're going to compare this to, which is really, I'd say that the ideal comparison is people that are talking about doing Roth conversions. And so we're going to talk about the differences between doing a Roth conversion versus pulling money out of the 401k or the IRA, paying a little bit of tax now, which we can also help you with tax strategies on that. That's just part of what we do when we're looking at the whole strategy. But then ultimately letting that go into a tax-free status versus tax deferred and have it be tax-free to you, minimizing your future ordinary income required distribution. So you still will have to take out the distribution at 72, but we're talking about draining that, moving the buckets, and shuffling the deck. And so what I want to have Hobie talk about is the difference really between what we're talking about in a Roth IRA, and then we'll go show you the numbers.
Right. Because the idea would be, listen, if you're still funding, right, if you're still accumulating and funding, you've got an option to do a non-deductible IRA and then a backdoor rollover into a Roth IRA if you make too much money and you're not ineligible to fund a Roth IRA. Or if you are eligible to fund a Roth IRA, because your income is below that threshold, that would be one option to create balance in your retirement portfolio, right? And then when we look at what is the alternative to that, right? There are not very many places in the tax code where you can do tax-free planning. Roth IRA and inside of a life insurance policy are really the two most utilized, mainstream, and most efficient ways of doing this. So basically in this comparison, what we've done is we've just kind of ran through what the features are and done a side by side. What can and can't be done with these different strategies. So with the Roth, we're looking at a $6,000 or $6,500 contributory limit, right? Versus using the insurance, it's unlimited. So for those of you on the webinar here that are highly compensated, $6,000 a year contribution may not be enough to even move the needle or to even begin to think about supporting a lifestyle in retirement. So it's just simply not enough. So that's where the index life or the life insurance policy may make a lot of sense, is because you're able to fund at a much higher limit than a $6,000 or $6,500 annual contribution. Then when we think about each year, some years may not go so well. Maybe in 2020, business was down and you're not in a situation where you can contribute to your retirement plan. Where if you miss a contribution to a Roth IRA, you cannot go back the next year and put in your $6,000, $6,500 for the previous year and for this year. Once you miss your opportunity, that is it. Where with the life insurance policy, you're able to go back and make those contributions for missed years, or backfilling, I like to call it. Early access. In addition to funding it, well, can I access this money prior to 59 and a half? Well, inside of the life policy, that's unrestricted. There is no 10% penalty for accessing gains inside of the contract prior to age 59 and a half. Or with a Roth IRA, if you access more than the basis, you will be charged a 10% federal penalty. Return potential in using the insurance vehicle, typically we see an 8 to 15% return depending on the product. Theoretically, if you're using equities, theoretically the return is unlimited. However, the best year to date when we put this together was 34%. Loss potential, the insurance product has a 0% floor. right? So it gives you some downside protection in your overall retirement plan versus if in the Roth, if it's equities based, worst year on record was 2008. Theoretically, you could lose it all, but the worst year was negative 38. Is it reportable?
Hobie, can I say one thing?
Yes.
As a professional, I've been practicing law for 25 years, counseling people in estate matters.
Okay.
And we've had these sharp downturns. They're relatively short. People panic and they say, my stocks are down 30%. I can't sleep at night. I don't know what I'm going to do. I'm going to outlive my money. And they panic. And what do? They sell. And then they're worried in the future. Not only have they lost, and then they're worried if they're still in, and if they get invested again, then they're worried. So this is a really basic level concept, guys. If you're laying awake at night worrying about your investments, you have the wrong investments, okay? Because you should not be worrying. So, and the older you get, the more important it is to manage risk, because it's not like, hey, I'm going to make a lot of money. It's just, you just want your money back that you've invested, right? I mean, that's a big part of that. Christina, I don't know if you want to add any.
Yeah, one of the things that we use this strategy for is also to systematically de-risk a client's portfolio. And so if you go back one slide for a second here, this talks back about the tax rates that Hobie mentioned in the very beginning. So if you go back one slide, there we go. So even though on a Roth, you're looking at limited $6,000 contribution a year, what we're looking at is, as opposed to doing a Roth conversion, this could be an additional or different strategy where you take out $50,000 out of your $1 million 401k. You pay taxes now at the 22 or 24% tax rate in order to avoid what would be maybe a 35 or 42 in retirement. And we then pay the tax now in order to let it grow tax-free and come out tax-free. And so, this is also a way, if we're pulling out 50 grand a year and we set like a 5 or 10 year plan where we say for the next 5 or 10 years, we're going to pull out 50 grand a year out of the 401 or the IRA. Then what we can count on is also de-risking that 401k that might be all index funds. It might be causing you to lose sleep at night getting closer to retirement because you don't want that much volatility. So if we take out money, putting it into this strategy, this has a 0 downside risk in this product. So, so that's really what we're talking about. And then what we probably want to go to is the comparison of the Roth versus the life insurance. And so one of the greatest questions that we get is, well, there's a cost associated with life insurance. And what's the real difference here in the long run? So I want to have you speak to that, Hobie, and then we can probably get into some questions here.
Sure. So on the left-hand side, whether you choose to do a Roth, and that's something that your advisor, Christina, would be able to walk you through the different choices, whether you chose to do a Roth or you chose to use the insurance vehicle that we've mentioned, there are expenses, there are returns to be talked about, and there are benefits, right? And so if you look at the left-hand column, you're looking at a Roth with a basic 1% management fee. Almost everyone is paying more than that, regardless of which advisor that you use or which platform, but we're just using that as a baseline. And then on the right-hand side, we've got all the expenses of the insurance policy built in as well. So when you look, the top two circles, on the left-hand side, it says $35,622. On the right-hand side, it says $217,858. So what that's illustrating here is if we were just simply funding the $6,000 a year into both plans side by side, and something unfortunately happened and we were to pass away after only funding it for 5 years, what would your family be left with after only funding for 5 years? Well, you'd have only $35,000 in the Roth IRA versus a death benefit of $217,858 inside of the life insurance. So you can see that the one has a self-completing aspect, right? That hedges risk of not being able to fully fund that retirement account all the way to retirement, and adds a layer of protection for you and your loved ones. But, we're not super focused on dying. We're focused on living and what the benefits and tax benefits are of this planning. So as we come down, if we look at the actual values, right, the dollars and cents, and we get down to 30 years out or age 69, right, you've got 447,000 in the Roth IRA net of expenses, and you've got 481,000 in the policy net of expenses. So what that means is if we're showing both of these at a rate of return, like Christina had spoken about at 6%, and you extract the expenses from both of the plans, we said it was 1% on the Roth, and basically it's all built in to the insurance policy here. If we're giving it the same rate of return of 6 and we're pulling the fees out, and you have more money inside of the life insurance policy than you do in the Roth, that means your expenses were less than 1% to hold it over that 30-year period of time. So when people come and they say, hey, using the insurance policy is an expensive way for me to grow my money and to have these benefits, the math just simply says otherwise. And if you look at the actual fees, that's the third set of bubbles down in the bottom in the margin. I don't know if you can see that, but they're very, very close, right? So if all else is equal, if the growth is equal and the expenses are very close together, well, what are the major differences between the two? Well, one has a self-completing component, right, through the tax-free death benefit. It also can provide for long-term care needs, right, without having to buy additional long-term care insurance, which can cost $3,000 to $5,000 annually and is a use it or lose it benefit. Also, we don't have limits on how much we can fund into the life insurance policy like we do with the Roth. We don't have income limits that we have to, be cognizant of. So there are a lot of tangible benefits that the policy can provide that the Roth simply does not. Again, not trying to show you that one is better than the other, just trying to compare and contrast the realities of the two planning options that are available to help create that balance in your retirement plan so that we can manage the taxes and the amount of taxes that you pay when you do get to retirement.
What I want to talk about real quick is the very next slide, because obviously this is showing someone that's kind of, do I fund a Roth or do I fund a life plan, which is what we've called this. It's a type of a life insurance. It's an indexed universal life policy, but it's designed as a life plan. So we showed on the past slide, someone funding over 30 years basically into a Roth IRA versus the life insurance. But what we also want to talk about is the person that's maybe 55 years old now that has a $1 million+ 401k or IRA that they're maybe still contributing to for the next 10 years before they retire. And then they're going to be looking at a 6-figure, 100 to 200,000 plus required distribution at 72 in a higher tax bracket environment. So what we've looked at and illustrated here is someone that we strategically take out $50,000 a year. Now I want to hit real quickly because one of the comments or questions we're probably going to get is, you have a penalty if you take money out before 59 and a half. There's a rule called 72T. If we take out substantially equal distributions, we can actually start that sooner without the penalty. So 55 is an ideal time to look at that. And so if we start at 55, we can take those distributions. You cannot take out 50 and then take out 100. So it does have to be substantially equal, but we can avoid the 10% penalty. Just pay the tax now in order to have the benefits later. So this is illustrating $50,000 a year coming out from age 55 to 65, paying a little bit more tax. You still have the ability to work probably and defer and still get a tax benefit for your deferral. But this is a way to take some money off the table. And then looking at the life plan on the next slide here, this is then letting that money sit, defer, and then start to provide you an annual distribution of $73,000 a year, tax-free, starting at age 70. Now, if we wait till 72, all things being equal, which would be your required distribution, that the longer we wait, the greater your annual income. And if you were to then come to us and say, at 68, I really can't wait till 70. I need more income now. We can look at taking income sooner. It just means less income on an annual basis. So there's flexibility. These are not hard set lines as to how this plan will work. There is some degree of flexibility in it. But I think now is probably a really good time to open it up to questions.
Yeah, so we got a lot of questions here. One is from Arlene. She asks, what if you are already 70 and still working? Can you put the entire $500,000 in at one time?
Yes. Hobie, do you want to speak to that?
Yeah, you can. So there are several ways that you can contribute to these, and you could position yourself to be able to pay the taxes on, if you're still working and you're highly compensated and you have and would give you access to the money tax-free in the future to pass that money to the next generation, tax-free as well, or what your needs really are. But there are definitely strategies for those folks who are, in their mid 60s and early 70s. It's not too late to have that conversation with Christina to figure out how you can save money on taxes on a go-forward basis.
So Arlene follows up with a question. Also, wouldn't the cost be very high at that point for insurance? Arlene, if you smoke 3 packs a day and drink a fifth of bourbon and you're 100 pounds overweight, yes, because health and lifestyle does affect premium. But Christina, do you want to talk about that? I mean, does it make sense for someone who's 70 to buy life insurance?
It may. It really just depends on your unique situation, your health, your overall assets, and how long you intend to continue to work. And that would be something we'd have to analyze in depth of what your situation is. And that's one thing, that this is not a one size fits all solution. This is one of many. And it may mean that we do a combination of Roth conversions. We maximize your current tax bracket now, and we do some of this life insurance as an additional plan. Maybe you have a gap in your plan for long-term care insurance. So maybe we do a part of that to cover that. So what we do with Ascent Wealth Management, because we are completely independent, we don't work for a wirehouse. We're not an employee of a Wells Fargo, Edward Jones, UBS, or any of those mainstream firms. We have complete independence in being able to go seek the best solution, have access to the best carriers. Midland National, I've been working with Hobie for a long time, is one of many that we use, but they are very competitive, and A-rated carrier that's been around for over 100 years. So we're not beholden to using an in-house product, and we can really look at your whole situation to determine what is the best solution for you.
Anonymous asks, my biggest fear isn't the spending less, it is becoming single, death of a spouse, and that's causing me to be in a much higher tax bracket overall.
That's another feature where this is something that we want to consider, because these withdrawals coming out of a policy don't affect your Medicare Part B premium, which does go up when you become a widow, and your tax rate goes up. And this is where there could be a death benefit to plan for. So those are some things that we want to look at.
Yeah, Christina, I'm really glad you mentioned that. And this is, if you Google, it asks income limits or on Part B Medicare. The Medicare, CMS, the Medicare, the government tells you if you hit this certain level of income, your Part B premium increases significantly. And so that's another factor in when you're calculating the overall cost of this. And I will tell you, that's a backdoor way of taxing your Medicare benefits, right? By charging you more. So if we're going to enter if we're entering a higher income tax environment, I could see those premiums actually going up even more. So Walter,
that's one of those things that, in speaking to the original tax problem and looking at those tax brackets of what, we could be looking at, if you have a 6-figure RMD get added to your Social Security, your potential pension, other income, you could be looking at a very high Medicare Part B premium, which is the thing most people don't think about. This is a solution to also not have income added to your taxable income for Medicare.
I think what I would leave people with is, look, there are things like taxation on Social Security, 50% versus 85%.
Yeah.
There are Medicare taxes. They've talked about putting a means test to Social Security income, dependent upon the total amount of outside taxable income you have coming in. There are a lot of different taxes to be thinking about. There are also a lot of different tax environments, and these things will go up, they will go down, they'll be ever changing. But if you had a choice, would you choose to have flexibility and control, right, of how much taxable income, right? If the dollars were the same, but you had more control of how it was, how it came out and what it looked like from a tax standpoint, wouldn't that be something that would be important to you to have within your overall plan? And to me, that answer is yes, yes, yes. And these types of strategies and things like this, like we're talking about, are going to give you the ability to just have more flexibility and control, to not just be a victim of whatever the tax code is at the time when you reach retirement.
Walter asks, the distributions are loans from the policy. Loan implies interest. Are there interest costs here? What's a typical interest cost that you see?
Yeah, so there are contractually zero cost loans available within most of these plans.
Okay. Gordon asks, is the life plan an annuity?
It is
No.
not an annuity.
Life insurance. Anil asks, when the IRA is moved into insurance or a charitable remainder trust, isn't the IRA withdrawal taxable? Have the taxes been taken into consideration? I think what Anil's asking is, if you take money out of an IRA and then put it into an insurance policy, or you take your money out of an IRA and put it into a charitable remainder trust, isn't it taxable? Yeah.
Yes.
And the taxes do need to be taken in consideration. But Anil, here's the bottom line. And I'm going to give this to you straight. Rich people pay less taxes because they have three things going for them. Number one, they can hire great advisors, and you're looking at three of them. Number two, they take the advice of the advisors and they take action. And number three, they typically have more capital. They have more assets. And when you have assets, that fundamentally lets you pay less tax. Anonymous asks, is there interest paid to an insurance company on the loan? We answered that. Is there a fee or a charge for the loan? We answered that. It could be zero. What strategy would you suggest for currently retired, age 78, taking RMD retirees?
That would be something where we'd really have to analyze your tax return, and we do offer other tax planning strategies. So we can certainly have a complimentary consultation and do things that are not life insurance based at that age.
Anne asks, when does one start this? At age 30?
The best answer is always yesterday, depending. You can start various plans at 30, 50, 60, 70. It just really depends on your unique set of circumstances.
Rebecca asks, what happens with a $20,000 annual contribution if I'm age 70? I think the question is, if I put $20,000 a year into a life policy, what happens? I think the numbers are just smaller, aren't they?
Yeah, the numbers would just be different. And maybe this wouldn't be the best policy for you. It depends on, again, your set of circumstances and how long you can afford to defer, because the winning strategy is here, how long you can use other buckets of assets until you need to draw from this.
Anonymous asks, for younger taxpayers, does it make sense to contribute to insurance rather than an IRA or 401k, as the premium is lower at younger ages? So that's really a binary question. It's an either or. What do you guys think?
Or a combination.
Yeah, I think that's the right answer, is you need to look at both. Those tax deferred savings vehicles, if you're younger, are extremely powerful. I personally have my 401k with Christina. I'm 51. The money I'm putting in the 401k, I'm fully putting into my 401k. I'm invested in an aggressive stock portfolio because that is a piece of the overall financial picture. So it's really important to work with a professional like Christina, and she can help you get the best plan possible. Anita asks, I'm over 82, still working. Would an RMD from an annuity withdrawal be tax-free?
Would an RMD
from an annuity withdrawal be tax-free? Is this even possible, or only paid upon death? If so, would it be wiser to withdraw from the annuity instead of the IRAs?
It depends on if the annuity is qualified. So if the annuity is qualified, if it's an IRA annuity, then it's taxable because that money's always been tax deferred. If it's a non-qualified, meaning a non-retirement annuity, it depends on the annuity and what their tax policy. I would say rule of thumb is most annuities out there. The rule of thumb is that the last money in is the first money out, meaning you're going to pay ordinary income before you get access to your cost basis tax-free. We do have some annuities that we work with that apply a private letter ruling tax assessment to that make the withdrawals part tax-free, part taxable. So that would be something that would be worth doing an annuity review, and we'd be happy to help you with that.
You know, I also wonder, could Anita, if she has, it sounds like she might have a rollover IRA. If she's still working, she's 82. Is there a way that she could set up a new plan and essentially roll the IRA back into a 401k?
Once it's in an IRA, over your RMD age, you can't go back into
Okay. All right. That's why we got experts here.
Mm.
Anonymous asks, how much are the services for wealth management? What do you see?
So that's a great question. And it is a very, very good question. And it's a broad answer. And here's what I'll say is that we are a hybrid office, meaning that we've got the ability to do things on a commissionable basis if that's what is in the best interest of the client. And I will say that we are a fiduciary, and not just a fiduciary, a general standard fiduciary, general securities fiduciary. We are certified financial planning fiduciaries held to the highest standard in the industry. So we will always do what's in the best interest of the client, fully transparent. If it is a commissionable transaction that is in the best interest over the long run, we can look at that. If it's assets under management or charging a small assets under management fee, we can look at that. Advisory fees are no longer tax deductible. So sometimes it makes sense to do an asset management fee on an IRA that's tax deferred, and a fiduciary fee that's tax deductible on your non-qualified accounts. If you're a business owner, sometimes we will look at doing a fee that is charged to your business that is tax deductible. So that is a very long answer of saying, because we're independent, and we are certified financial planners, we have the flexibility to do what is in the best interest of the client and look at how we should assess that fee.
You know, as you're talking about this, Christina, I'm thinking we should probably do a webinar on, like, how does the whole fee for financial services work? What's really going on? If they say, oh, we don't charge any fees, just because they say they're not charging fees doesn't mean you're not paying. It may not be a fee. It could be a whatever. Anyway, Anonymous asks, I am currently in a 25% tax bracket. I'm assuming just federal. Maybe you're not in California. If I follow your plan and withdraw $50,000 a year from my 401k, I would get a $12,500 tax hit, therefore a reduction of $12,500 of monies I would normally have available to me annually. Not sure if I can take the $12,500 annual cost. Also, I have pre-existing medical condition and my life insurance premium may be higher.
That's one thing that we'd have to look at, because, sometimes things that the life insurance carriers used to not underwrite for, they do. So, as we've become more advanced in the medical profession, there's things that life insurance carriers are more lenient on. Now, the $12,500 tax hit, we can also look at tax strategies to offset that. And maybe $50,000 a year is not the appropriate amount for you. We have to look at what your bracket is, and maybe it's $25,000 or $30,000. We really have to look at what is the sweet spot. But what we will typically see is that within that 10-year of deferral, we're going to offset that from an account value, and that will be a future account withdrawal that will be tax-free. So you have to look at really the tax implication, and is it really costing you $12,500? What would that $12,500 compounding cost you on taxes later? And so there's really some analysis that has to be done there. And then if you look at that $12,500 tax hit now and the cost, if something were to happen where, I took the cost, I paid the penalty now, I didn't get to recoup the benefits, something tragic happened, you passed away early before recouping the income benefits, there's a death benefit that's greater than what your cost is to cover your heirs. So, you really have to look at this with a deeper lens and kind of take a step back and go, what is the real cost?
Anonymous asks, 401k, Roth IRA, life insurance are all financial strategies used depending on the finances of the person. What about real estate? How can you get rental income and appreciation of equity? How does real estate compare to the 401k, Roth IRA, or life insurance? I think the question is, should I put my money in real estate, or should I invest in, IRAs and 401ks? I think that's something you're just going to have to, answer for yourself. Probably it's a yes, and it's probably both. Agnes says, please, information on fees for financial advisors would be helpful. We actually have one on how much should a living trust cost on our YouTube page. Do you work with 60-year-olds who are well-educated, ambitious, thankfully in good health, and starting all over again financially after a devastating divorce, and want to still leave a legacy to the son with mild special needs? That's probably half our clients.
Yeah, yeah, we're happy to help. And so,
Yeah, yeah.
Jim, if you can also put up while we're answering these last few questions,
Uh-huh.
our contact information.
Oh,
So
yeah.
that, there we go.
And then Anonymous asks, what strategies are possible to avoid increases of property taxes on rental real estate due to Prop 19? There's a lot. I will just say on a high level, I'm less concerned. There's a hierarchy of concern, less concerned about rentals and reassessment because you have the income to pay it. I am most concerned about residences and vacation homes. But there are a lot of strategies out there. Unfortunately, our firm has taken a pause on accepting new clients. We're just really overwhelmed by demand. So, but there is another way. We're going to cover that February 16th. There's another way that you can preserve Prop 13 other than using a trust and a parent-to-child transfer. Last question, and we'll end it with this. What are the downsides and upsides to taking $50,000 out, paying the taxes, and enjoying the extra $38,000 right now? As I have a 7-figure IRA and pre-existing health, dad died at 65 and mom at 75. I do have 2 sons. The question is, should I just take it out and spend it?
We really need to look at what your overall assets and strategy are. And that's really where having a very comprehensive deep dive of what your situation is.
All right, guys, it was a pleasure. Christina, thank you so much. And Hobie, thank you for joining us. And please subscribe to our YouTube page, check out our other videos. We got subscribe because it'll appear in your YouTube feed and you can just keep learning more stuff. So thank you everyone for coming today.
Thank you.